Ladies and gentlemen, good day and welcome to the Q3FY23 earnings conference call of Gufic BioSciences Ltd. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Ami Shah, Company Secretary. Thank you. Over to you, ma'am.
Thank you. Good evening and a warm welcome to Gufic BioSciences Ltd. Earnings conference call for the third quarter of financial year 22-23. I have with me Mr. Pranav Choksi, Chief Executive Officer and Whole-Time Director, Mr. Devkinandan Roongta, Chief Financial Officer, and Mr. Avik Das from Investor Relations team to give the highlights of the business performance of the company and to clarify all the questions of the investors during the call. We will begin the call with the business highlights and overview by Mr. Avik, followed by financial overview by Mr. Roongta. After the opening remarks, the operator will open the bridge for Q&A sessions, but before we proceed with the call, please note that some of the statements made in today's discussion may be forward-looking and are based on management's current expectation, and this may be viewed in conjunction with risk and uncertainties involved in the business. The company assumes no responsibility to publish or update or amend, modify, revise any forward-looking statement based on any subsequent development, new information in future, or except as required by the applicable laws in force. This call is being recorded and the playback of the call has been made available or will be made available on the website of the company shortly after the call. The transcript of this call will also be submitted to the stock exchange within the stipulated time frame. I'll now hand over the call to Mr. Avik for his opening remarks. Thank you. Over to you, Avik.
Thank you, Ami, for your opening comments, and welcome everyone to our call. I'll start with giving you all an update on the Indore project, and subsequently I'll follow it up with some of our key developments in each of our business verticals. So with respect to Indore, as you all are aware, we focused all our energies in ensuring that we are on track with commercializing our Indore facility. I think it's about time that we give you all a deep and detailed insight as to the progress of the facility. So with respect to our civil work, we are very happy to inform that our main plant, our utility block, and our R&D block, we've nearly completed 90% of the civil work. With respect to the main plant, we've about to commence the work on the pre-engineered building, which is the last floor of the facility. Now coming to the equipments, with respect to our imported equipments, which are primarily lyophilizers, we've received both our consignments. Albeit there was a bit of a delay given the lockdowns in China. However, we've been able to get both our consignments and the installation is underway. Now, with respect to our indigenous equipment, we've in cases like HVAC systems, transformers, and our manufacturing tank and vessels, we've received the materials on our site. The installation is under progress, and we do not foresee any challenges in terms of sourcing any of these equipment, and we hopefully should be on schedule to complete the installation. There may be some delays, and we'll keep you all informed with respect to that. Now coming to the various divisions, we've informed of the launch of Sparsh as a division. We are very happy to inform that we've completed our primary and secondary research on the field, which involved reaching out to nearly 5,000 hospitals, where we mapped the potential for around 130 molecules. These are specifically molecules of interest to us. Some of them we are already present, and some will be new molecules that will enter. As per our initial assessment, we foresee the annual market is somewhere around 500 to 600 crores, and we have now geared up to gain around 20-25% market share within the next year. So this involves creating a supply chain to source these molecules, to manufacture these molecules, and also a very innovative method to reach these molecules to the various hospitals. We've hired a team, a dedicated field force in this particular division, and we've started reaching out to these hospitals, and we should start seeing the division give us commercial results very soon. Now coming to Arisia, the Arisia clinic is now fully operational, and our friends and well-wishers who are there in Mumbai, we request you to, you all can come down and visit and take a feel of the clinic yourself. And we've also started the knowledge sharing initiatives in Arisia, and as a process, as one of our initiatives, we started training gynecologists over there. And we have every 15 days we are hosting various speakers from around the world. Now in Amsterdam, we started the process for registering dermal fillers. We are very hopeful of launching these fillers also very soon. With respect to the dual chamber back, we are awaiting approval from NPPA, and we've kept the commercial launch on hold, and we'll keep you all updated as soon as we receive the approvals. On the international business side, we've received 3 product approvals, one each from Colombia, Kenya, and Philippines. And yes, that's about from my side. I'll hand over the call to Mr. Runta for updates on the financials.
Thank you, Avi. I will just give a financial highlight for Q3 of the financial year 22-23 versus the Q3 of financial year 21-22. The total revenue for the current quarter is 178 crores against the previous year Q3 quarter was 174 crores. EBITDA for current quarter is 34.1 crore. Previous Q3 was 34.2 crore. EBITDA margin for current Q3 is 19.1%. In Q3 of 22 was 19.7%. Profit before tax for current Q3 is 27.2 crore, and last year it was 28.7 crores. Profit after tax was 20.3 crore for Q3 financial year 22-23. Last year it was 21 crores. The PAT margin for the current Q3 is 11.4%. Q3 of last year was 12.1%. Thank you.
We can start with the Q&A session.
Sure. Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Gunit Singh from CCIPL. Please go ahead.
Hi, sir. So for financial year 2022, we saw a top line of about 780 crores, but right now for the trailing 12 months, we are doing around 680 crores. So do we see us surpassing the revenue that we did in financial year 22? And also, what is the reason for the revenues to be lower for the trailing 12 months as compared to FY22? That is my first question.
So thank you for your question, Gunit. Pranav here. So just to give you a little bit of a background about the revenue as such, if you see the revenue in 22-23 was, the revenue which is going to be in 22-23 on a run rate is around 170 per quarter. But last year when you saw 780, that also had an impact of the COVID also coming in. So there was almost, like we have mentioned in the previous few calls also, almost to the level of 175 to 180 crore of revenue was a one-time revenue which we have recorded last year. due to the COVID reasons. And if you compare the revenue before that, then it was 487 on a annual level. So from 487, we had gone to 780. Then we had clarified that there was a one-time revenue capture of COVID and COVID-related drugs, either due to COVID or due to black fungus and mucormycosis. And that was a one-time thing. On the contrary, this year we have taken more than 22 crores of stock back, which was built assuming that the wave 3 and wave 4 would have come, but that has already been adjusted in the net revenue this year. So that's the reason you are seeing, going 487 to 780, whereas in this year you are seeing an average of a quarter revenue of 170. So that's the reason. So overall, as a company, we are still growing by minimum 15 to 20%, if you factor out the one-time COVID revenue.
All right. And I have two more questions. I'll just state them out right now. So the first question is that we historically have seen our operating margins to be around, say, 10 to 13, 14%. But currently for financial year 22 as well as right now for 9 months, we are seeing our margins to be around 19 to 20%. So I would like to understand the reason for this jump in margins and whether this will sustain in future and what will be our steady state operating margin. And the second question is that you mentioned that the Sparsh project that we have launched, we expect to gain about a 25% market share in that. So I would just like to understand by when can we expect this to reflect in our revenue figures. So given that the market size is about 500 to 600 CR, can we expect that in financial year 2024? Can we expect about 100 to 125 CR from Project Sparsh? This is my second question. Thank you.
So I think in terms of your margin, I will request Roonghta sir to answer that point after I finish my reply to the Sparsh question. So I will take the Sparsh question first. So Sparsh, just to clarify what Avik said, the total molecules which we have planned to take is around close to 300 odd molecules, which represent a total of 9,500 crore market capture out of the total 1,90,000 crore Indian pharmaceutical market. So out of the total market of 1,90,000 crore, which is the total Indian pharmaceutical market, these 300 odd molecules in phase 1 and phase 2 comprise of around 9,500 crore. Out of they comprise of about close to 9,500 market representation. Out of that, we have launched around 130 molecules in phase 1. The total 130 molecules in phase 1 comprise of at least 7,500 crore market representation. Out of that, we have selected that down the line in the next 5 to 7 years, we should be capturing 500 to 600 crore market input in terms of Gufic as a company. So from that, we feel in the first 2 years, we should be capturing a 20% market share, and you rightly said. So we are looking at the launch has happened in December. This quarter will be, so for the first 2 months of the launch, rather than starting the sales, we have spent a complete energy and effort first to just map out the market, because once the team gets busy in operational matter, we don't spend time in market intelligence. So we have actually not only for the period of from starting from December first week all the way till actually not even January end, February 10th, we have asked them to just go around and capture the market where we have keyed in and mapped out the primary, secondary and tertiary, I would say hospitals and nursing homes in the area of operation in the current geography. So the geography is around 5 states, just to clarify, and that is where the numbers are coming on a more, I would say, titrated manner. And then we will be gradually, if that works out in the 5 states, we will go to the other states also. Coming back to this market, so this market intelligence will help us in 2 regards. The products which have been selected in Sparsh will be different from what is there in the critical care division. So once we get more insight about the market, this list of primary, secondary and tertiary, I would say healthcare centers will also be used in terms of market penetration by the critical care division, where we already had more than 200 people also. So we are looking to expand our current market share and our penetration in Indian market, getting more data on a real-time basis in terms of hospital counter rather than geography right now. So when we go for hospital counter, the business becomes more predictive. At the same time, we can also learn in terms of, we're also using some specific, I would say, these data tools, or we're looking at some, data analysis points by which we can come to a little bit more of a predictive business down the line, and keeping in mind also the consumer, selection. So depending on the geography, depending on the area, depending on also the pin code, we can come to know what sort of prescription guideline or drug usage guideline is being followed in different parts of India, which helps us to also come up with a better basket, which is catering to very unique markets rather than having a common strategy for the rest of India. So this is just, I'm clarifying. So this Sparsh will start capturing revenue from February end. So this quarter you will see approximately 2 months of revenue capture from Sparsh. And going forward, yes, we hope, and that is our target, that we are looking at close to 100 crore run rate from next, I think at least not in 2023-24, but definitely for 24-25, we should look between 100 to 125 crores going forward. This is answering your second question. Coming back to the margins, I'll hand it over to Roonghta sir to please answer your question.
Sir, regarding your EBITDA margin, if you see the EBITDA margin from the financial year 16-17 till 19-20, it was in the range of around 13 to 15%. When our turnover was in the range of around 250 to 400 crores. Now from 20 onwards till 23, the margin has been improved from 18% to 20%, and the turnover has also been increased from 400 to around 600 to 700 crores. Whenever there is an increase in the turnover, the fixed cost remains not going to increase in that ratio. For example, our salary cost in 16-17 was around 15% to 16%. Now it has come down to around 12%. So whenever there is increase in the turnover, the same ratio, there is not increase in the fixed cost. That was the reason that our EBITDA margin has been increased. And whenever in future also, if the top line is going to increase, EBITDA margin will going to further increase. Thank you.
All right. Thank you very much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Yash Tanna from iThought PMS. Please go ahead.
Hi, good evening, and thank you for the opportunity. My question is, we have given a guidance of 15 to 20% on an ex-COVID basis last year, and I think now maybe to meet the lower end of the guidance, we'll have to do about 200 crores quarterly run rate. So do we still maintain the guidance of 15 to 20%? And over the medium term, that is next 3 to 5 years, what are our growth aspirations?
So thank you, Yash, for the question. And yes, I think just to tell you, there are a lot of growth levers which we are working on side by side, and as I've been discussing, of course, Indore being there would definitely add as a Indore. When I mean Indore, the new manufacturing facility which is coming up in Indore, which will be commissioned by June or maximum by first week of July 2023, will definitely add in that number which we see, because the capacity in Indore would be at least 2.5 times to what we have currently. The capacity in Indore would be around 1.5 times. So the current total capacity of Gufic would become, almost 2.5 times what we are currently. So that would definitely help the number. Of course, Indore will take time because we are looking at a regulated market strategy along with the Indian domestic market growth. So initially, when we look at a capital utilization of around 15% to 30% to 60% in year 1, year 2, year 3, automatically the numbers would start keying in. We also are looking at our domestic business presence in all these 6, 7 divisions. Now 8 divisions if you consider Aspirin and Arisia also. So there we are looking at organic growth coming in from there also. We have got some, I would say reduction in the growth percentage in terms of the contract manufacturing would not increase that much. But with international business kicking in and more country registration coming in, we foresee that the averaging, even though the base of international market is low, we still feel the higher growth percentage is there, followed by the organic growth in the domestic market plus Indore kicking in would help us to ensure the 15-20% growth year over year. Of course, there are other business avenues in terms of research. As you mentioned, the biological research is happening much thing, and that's one of the reasons we have seen the other expenses in this year go up, because a lot of our, I would say, basic research into biologicals, apart from even toxin, new drug delivery systems, and also some new peptides, is still continuing. So all these are being worked out in the background to ensure in year 2, year 3, year 4, year 5 also, along with Indore, we maintain a minimum run rate of 15 to 20%.
All right. Thank you.
And just to add to what Mr. Chokshi said, last year we did our top line at about 170 crores of COVID revenues. If you exclude that, we would still be doing a growth of about 15-20% this year.
Okay. We consider a base of 620 crores, right?
Correct.
All right. And in terms of our newly launched products, I'm referring to the last investor PPT, products like cetapixime, Avibactam, dydrogesterone dual chamber bag. So how have these been performing? And I believe out of these, dydrogesterone would be a significant molecule, and one of our small peers have also gained about 3-4% market share. So how has that been for us, new product performances?
Yeah, correctly said. Just to clarify that, as we mentioned the last call also, ceftazidime avibactam was something where the R&D had happened in Q3, and we were looking at the launch in Q4. So on January end, we have launched the molecule in India. So the ceftazidime avibactam revenue would start kicking in from the Jan to March quarter. That is number one. Number two, dydrogesterone tablets. Yes, since we have launched in around 2 different divisions, and now we have a third SKU also being launched for a specific market. We foresee that this brand should be very close to a 10 crore brand in the period of less than 2 years also, less than a year and a half. So that is something which has further increased in the third quarter, and we foresee a traction happening in the fourth quarter and so on. The dual chamber bag, specifically Biopenem, is what we got the permission, plus we have the permission for Meropenem and Cetirizine Tazobactam also. But since we had applied for NPPA had given us only a 15-20% MRP allowance beyond the current limit, which was not feasible. So we have re-represented our case to them once again in the month of December and once again in the month of January. Then we were told that Meropenem MRP would be under reconsideration, and hence we were asked to wait till the actual MRP of Meropenem is established by them for a normal conventional dosage. So now, just I think a couple of weeks ago or 3 weeks ago, the draft of the MRP of Meropenem has been out. They would be now finalized hopefully in the next 1 or 2 weeks, because they give the industry 10 to 15 days to come up with their feedback. So once the MRP of Meropenem is established, then we will be able to apply for a new MRP of Meropenem. So having in a nutshell, dual chamber bag, even though we are ready, we are more than gung-ho to get, even the market is very gung-ho about it. Till we get the NPPA permission to launch the product, we will not be in a position to launch the product. So I foresee that even normally we do not launch any major products in the last quarter. So I am looking at now, assuming that the procedure should be done in Q1 to launch the product in Q1. So the revenue of the dual chamber bag should start capturing from Q1 2024. So that is about the 3 timelines of the 3 different products which have been launched.
All right, sir. And sir, in terms of...
Sir, we request you to please rejoin the queue for further questions.
Sure. Thank you. And that's all, sir.
The next question is from the line of Ajinkya Jadhav from Kamayakya Wealth Management. Please go ahead.
Yeah. Thanks for the opportunity. I would like to know how is the traction in Stanox and Garvot?
So, Stanox is, I think, doing reasonably well. I think, as we had mentioned last time also, the growth percentage month over month is still being maintained. and it's going on. We hope to, close very close to, I believe, almost 4 times sales over last year, hopefully by the end of the year, keeping in mind Sanofi. Zarbot, unfortunately, we initially thought of getting the same from our critical care division, where we had 200 plus people by having a special team done. However, then we realized very soon that critical care, caters to a very different, even though it's part of the critical care system, intensivist and anti-infective is a specialty. And we needed a team which is much more catering to neurological in terms of their basic knowledge and core competency also. So from November onwards, we were in the process of recruiting a separate team, which would be catering to the neuro care division. And we also have, recruited some specific, experts who have already handled the toxin in the past with their previous companies. So we feel that even though Zarbot has launched and it has reached a basic growth, it's not growing as fast as Sanofi. But with a new team coming in who is much more, well linked and much more technically, adept in handling the toxin with the right target audience, we should feel that it should start kicking in from March or April. The team was recruited all the way from September. They start joining in from November, and the recruitment should be over by February end. And from March, you would have a full team who is dedicated to just selling Zarbot in the Indian market space. So this is the current scenario.
Okay. And from Eritrea, how many batches of the doctors have been taught out, and what is the size of the batch, like say 200?
Very different. Yeah. So Eritrea is more of a training thing, not that there's any, thing. So right now there have been more than 5 batches which have gone through, but it's more of a collaboration where we, discuss more about the new, new strategies or the new technical, practices which are happening in cosmetics as well as, gynec cosmetics, as well as we have tied up with Dr. Navneet Megon, who is from El Sante, who's worked on vaginal rejuvenation and vaginal tightening, all the way from, body and face contouring also. A lot of, information base which gets done, and almost, 5 batches have gone through, apart from 2 batches dedicated to, the cosmetic gynecology, remaining are for body and face contouring. So from December, when the Eritrea was initiated, till February now, around 5 batches have gone through.
Okay. And the last question is how is the...
We request you to please return to the question queue if you have further questions.
Yes, thank you.
The next question is from the line of Chetan Phalke from Alpha Invesco. Please go ahead.
Yeah. Thank you for the opportunity. So, Pranav sir, when do we expect EU certificate for our Indore plant? Is it in place?
No, sir. As Avik said, that the plant will be commissioned by around June 2023. Then there will be 3 batches validation taken for the target molecules, and then we'll have to wait for 6 months stability. So we are looking at the calendar year 2024 for all accreditations to start kicking in, be it EU or be it other countries, and eventually, if we find a suitable partner, then it would be the other regulated markets of America also. So the timeline will be 2024.
Okay. So do we intend to fill our capacities with some CMO contracts till the time we await the certificate?
Yes. So already we are in touch with, clients who are country specific. At the same time, we have some specific molecules which we will be marketing in India through Sparsh. So as you know, we believe in one single global quality. So there are a lot of new products which we will be right now launching in Sparsh, which would be manufactured in Gufic right now, would be outsourced from a third-party vendor, but they would be eventually made in Indore. So Indore would help us for the economic of scale and the right pricing and the right quality to make those products started. So the initial capacities would be with Sparsh plus CMO plus then there would be some domestic market also, new products which we are working on, which we'll be launching, and eventually then we would have international business kicking in.
Got it. So for CMO business, how does the margin profile look like? Because we have been seeing this over the last couple of quarters. There is a compression in CMO margins across the pharma value chain, and a lot of CMO plants have come up in the last 2 years. So are we seeing any pricing pressure, and do we intend to reduce our pricing, especially in LiFO, in order to maintain or retain our market share? What is your outlook on the pricing?
So again, I would say that the CMO margins are actually not what is eroding in the last few years, very frankly. I would say the reason with the margins we are seeing is being, I would say, compressed. I'm saying purely in the critical care space or injection space would be the increase in inventory. So if you see post-COVID, not only in India but around the world, a lot of inventory has been kicked in. And because of the inventory being kicked in, assuming that, a wave X, wave Y, wave Z would come, a lot of people were stuck in that, and that had led to some sort of a slowdown in the CMO business overall. Having said that, since most of the products which are manufactured in April to September 2021 would be getting either expired or would be sold out in the next 6 months, we feel that CMO would still be intact. Keeping in mind the competition, there are very unique products which we are working on rather than, of course, at the same time, we're working on certain Me-Too basket products also, which we keep on having. But economic of scale always help us to maintain the same margins. To answer in a nutshell, when we do a proton pump inhibitor, yes, we understand that the margin will be 25% on a very high volume. But then there are certain infectives and anti-infectives and export markets start kicking in when the margins go as high as 45 to 50% also. We also have to we have to be very clear that these are the gross margins, and in such CMO practices, there might be only the factory overhead which needs to be amortized and not any other employee costs or other expenses also. So we still feel that CMO would be an important factor going on, especially when we have new markets kicking in. As we have mentioned in quarter two, our Penem block also have started. So the Penem block was started in Q2. We started the validation done, and we have started filing dossiers for the Penem block in this Q3 and Q4. So we hope that even the Q3, Q4 Penem outlook also will start helping us from the next 2 years. So again, I say it's not about the margin shrinkage. It's all about just the question of being in that, time reference, which should automatically ease out end of this year.
Okay. So for the next 12 months, we don't see any significant pricing pressure or pricing cuts per se.
Not due to CMO. I think the only thing pricing pressure would come where the NPPA pricing is there and the Chinese API prices or any other API prices go for a nutshell, keeping in mind environmental conditions of fuel and war, etc. So those are the only reasons which get into pricing pressure. Or like I said, most of the products which were coming to a near expiry or would be expired, people have just the last 2 quarters, 3 quarters just reduce the price and just load them in the market to ensure there's no loss of inventory. So that's the thing which we will not see in the coming future going on, except for environmental conditions.
Okay, got it. So sir, my second question is on the receivables and the debt. So in September quarters, I think our receivables have gone up significantly, 180 crores.
Right.
How are they looking now? And do you see this cycle reversing? Because I think the receivable days have gone up due to stretched payment cycle by most of the CMO partners. So what is your take on this, and how do we intend to fund the receivables? Because as we move ahead, our CMO business will become even bigger from the current days.
Right.
Our facility. So it will require a huge working capital considering the current run rate.
Right.
So just try to understand how the working capital cycle will look like. Will it remain around the current levels? And how do we plan to fund it, given that our debt is already around 170 crores? So just trying to understand your take on this overall situation.
Sure. So I'll answer that question in the form of a business point of view. Then I'll also request Roonghta sir to answer it in form of the balance sheet point of view in terms of basic numbers. But we have to understand one thing, that post-COVID, one thing has been very clear, and even after COVID also, even the last 6-8 months, we have seen the entire, I would say, credit line in India especially has been, loosened from, I'm talking about the CMO business first, and I'll come with the normal trade and so on and so forth. So the CMO business, which at one time was around 30 to 45 days to 50 days or 60 days, even big companies, I'll not name them, but even the top 10 companies of India now moved on to a 75 days, 90 days normal, credit period, keeping in mind the inventory which they want to keep going forward. This might be one of the reasons that, a lot of inventory must have been piled up, and that's why they must have pushed for that. I don't think that they will change this payment terms going forward, because this is something which is apparent not only for injectables, it's also all through for oral, topicals, and so on and so forth. Exports, as we are getting into more and more markets, so initially the exports was mostly, I would say, advanced or in 30 days. Now, since the channel partners are also increasing and we are helping them to invest and we are helping them, expand their basket also, they also have started investing in much more by keeping some sort of inventory for new products also. So the export market also would normally go between around 45 days to 60 days, which was around 30 days. That another 30 days thing would go up. The domestic market is something which we have still maintained, because normally the average payment cycle in the domestic market was around, ideally it was of course 21 days and 30 days, but we always Gufic maintained the 45-day cycle, and that 45-day cycle still continues to hold through. So that the domestic market on an average, if I take the averaging out of it, then it's a 45-day cycle which we look forward. So again, if you see in terms of number of days, we see the working cycle to be around these average days for these really different businesses. Again, API is a very small part of our business, but still API itself also has normally domestically 60 days and internationally around LC 60 days to 75 days, which normally get paid. So average, we always see our payments between 60 to 90 days, and that's why we always have a revenue, I would say, outstanding of around 75 days plus or minus on 60 to 75 days plus or minus on a debtor's point of view. These are my comments as a business point of view. I'll ask Runta sir to add if I've missed anything.
Thank you, sir. Basically, you see the balance sheet of Gufic for last September quarter as well as the March 2022 quarter. Average our debtors is around between 87 to 92 days, and according to 82 to 90 days, the average receivable is between 80 to 90 days. And if we convert into amount, it will come from, if our turnover for a quarter is around 175, 180, then the debtors will be, receivable will be 175 crores plus 12% GST average, it will go to 200 crores. That is about our receivable. In case of our stock, working stock, we are having around 1.5 months stock of raw material, around 1 month stock of WIP, around 35 days stock of finished goods, around 7 to 8 days stock of in transit. So there will be around 4 months stock of raw material, finished goods and WIP. And that also involve around working capital of inventory of around 135 to 150, between 135 to 150 crore rupees. That is the total working capital requirement of the company. Thank you.
Okay. So, sir, given this background...
sorry to interrupt, sir.
Yes.
We request you to please return to the question queue for further questions.
Sure. Thank you very much.
Yeah. We have the next question from the line of Aman Veej from Astute Investment Management. Please go ahead.
Good afternoon, Pranay sir. Just one request first and then question. So, any reason we have not uploaded any presentation this time or any remark on the number of products which we keep launching and the update on that?
Yeah, good question. Actually, this input came last time from the last question. Since we are giving the presentation and then we are repeating the same in the introductory call, they said, let's have only one avenue. So this time we thought we'll just have the introductory call and give only the highlights which are important, and then we'll come with the Q&A. But not only you, but I've got some 2-3 people also say that at least let's keep the presentation intact so that remains as a reference point, and then we can directly start the Q&A. So we thought that, and one more reason, we were planning to have from next time only update in every 6 months just to keep that information being more valid. So we were looking back review. So no other reason. It's just that based on the feedback, we took a call that it's much better in order to avoid redundancy, just keep a single channel of communication and information being out. No other reason.
Sure, sir. Finally, the two questions. The first question is on the Indore site. So you talked about what utilization levels we are targeting, and it will be a mix of domestic and CMO, at least for first 1 or 2 years. Before we get the approvals and move towards export. So for the first year and second year, maybe even third year, if you can talk about what will be the likely mix of CMO versus domestic.
Very frankly, I think I would never say no to any CMO business, but so I don't know how the CMO business comes, but as per the efforts and as per the structural approach to CMO which is going in case, we would still look at like a 50% module going forward, because like I said, Sparsh and our own brands would be there. We foresee that the Navsari infrastructure, keeping in mind the current registration which we have, would be completely utilized and would be completely chock-a-blocked by December or Jan 2023. So we will need to have all spillover business coming from Indore. More importantly, the current Unit 1 which we have in Navsari, which was currently also catering to certain WHO and PICS approved countries, so those also will be transitioning to Unit 2, which is a EU approved facility. So we are planning to convert once the Indore facility starts, the entire Unit 1 will be converted into a dedicated, I would say, hormone injectable block to, spearhead our infertility business also. So Navsari then would be Penem, would be hormone, and would be the EU GMP factory for general products. And then that will be complemented by Indore. So I still feel, I'm telling you right now, 50-50. There might be an instance that it might be 70-30 or, 60-40 here and there. But this is the ratio what we foresee would start off with. Because we see spillover business from domestic business coming in and being taken care of, not only by critical care or infertility, but also by Sparsh from Indore.
So just one clarification on this. So Navsari, you said, will be converted to a fully hormone/injectable
Unit 1.
facility.
Yeah, I'm just repeating again, so there's no ambiguity and no confusion. In Navsari, we have 3 blocks. Apart from the API block, the 3 blocks are including the legacy factory of Gufic, which is Unit 1. Then Unit 2 is the EU approved facility, which is approved in, of course, where the business of Germany and Portugal and UK and Canada and South Africa and all other real India businesses there. And the third block is, of course, of the Penem block, which was commissioned in Q2 2023. So I am right now talking about this Unit 1, which is a legacy block, which has been in part from a long time, because when Indore will start coming in, we will have excess capacity for the general lyophilized liquid and ampule things. So then that gives us enough foray to convert the Unit 1 into dedicated, I would not say, it's a dedicated block for infertility products like HCG, HMG and FSH, because a part of that block will be converted into the recombinant product also, which will be dedicated to recombinant FSH, which is again for infertility. So that entire Unit 1, which is a legacy factory, will be converted into a infertility products manufacturing site.
What can be the peak sales we can get from that Unit 1 after the conversion?
I'll have to check on that exactly and get back to you. But I will keep a note, and hopefully I think we'll get the details and we'll share it with you in the future.
Sure. Second question and final question is on so for 9 months, if you look at ex-COVID, if you remove the COVID portion, if you can talk about growth in our various divisions like critical care, fertility care, international business and API. The growth number if we remove the COVID portion so that it is like-to-like comparison.
So again, I would say critical care would be flat. The reason would be very simple, because we have taken a majority of the return. Like I mentioned, we have taken more than 22 crores of return of last year in this year also. Most of the return would be owing to the critical care and of course to some accessory divisions which we could not sell last year, which were kept in the channel because the channel was keeping it equipped for the wave X and a wave Y, which never came. So if I consider the net of that return, then it would be a flat revenue. But I foresee that with ceftazidime and avibactam coming up, and if I compare then on a 12-month basis, there would be definitely some 3 to 4% growth in the critical care division. Again, on the net sales this year versus the last year sales removing the COVID products, and that would be the number there. Infertility and healthcare are 2 divisions which have taken the major growth this year. So even though our contract manufacturing has reduced, the 3 divisions which are doing considerably well are healthcare, followed by ferticare, and then followed by exports, which are growing in more than double digits, and they are riding the wave and taking it forward. Healthcare has done its 100% achievement. They're doing 100% achievement. They are now almost on an 18% growth. Fertility is a little bit on a higher growth, but that would be also because of some new products like dydrogesterone what we have added up. That would be close to around 23 to 25%. I'm saying on a year-on-year basis. Again, we have to factor in mind that last year in infertility. Also during COVID, we sold some enoxaparins, which were part of infertility, but was something which was, due to the COVID. If I remove that, then we will be more than 35 to 40%. If I compare infertility this year with last year, removing the COVID products. Third, exports is something which is growing much more, but the base is so small that even though it's growing by double digits, that sale is not being met. And then, of course, I forgot to mention Stanox is the fourth one. Stanox is something which is also growing much faster, much higher. But again, the base is too small for it to have a relevance on the total revenue of the company. So these are the four things which are driving the growth this year.
Sure. I have more questions, but I get back in the queue.
Sure.
Thank you. The next question is from the line of Reet Jain from AGIPL. Please go ahead.
Hello. My question is regarding the geographical split. Currently, the major business is in India. What are in the medium term would be that the company has planned to cater the international market also?
So if I understood your question right, you would like us to talk about the geographical breakup of our revenue? Is that right understanding?
Geographical split, yeah. Current and what could be in the future.
Okay. So, firstly, we divide our business into India and export. Exports may be further the country which is leading the growth for us would be Germany, followed by, Colombia, followed by Sri Lanka. And so, I mean, I can go into individual countries, but I'm just telling you in a nutshell, these are three there. Going forward, we are getting more aggressive into EU. I mean, we just got an approval of UK I believe in the third quarter, and then we have filed in some tenders there. So we should see markets like UK and Portugal, which is already an existing market for us, also start catering much more. This year we will be finally, because after COVID we got enough time to work on certain more dossiers which we have worked on this year, and we would be filing dossiers in around 4 more European countries, namely Spain, France, Italy, and Netherlands. And those would be catering going forward much more. Southeast Asia as a whole also is now coming at position 3. So Europe is first, and then followed by South America, and then followed by Southeast Asia. In Southeast Asia, we also include countries like Sri Lanka and Myanmar and Philippines and whatever, because they also, even though they're part of South Asia, we consider that part of a Southeast Asia a strategic business unit. So these markets also now are expanding in terms of our growth going forward. India would still, of course, cater to a majority. When I mean majority, would be around, I believe, a 70% plus, 75% plus revenue in terms of formulation. Going forward also, we foresee, as I've always mentioned all these years, India would be a strategic market for us going forward in terms of our growth. So India, followed by these other countries coming in, we would maintain the ratio. Even now with Indore coming in, I foresee the ratio to fall to 65-35 or maybe 60-40, not below that. Because India will still be one of the growth stories going forward.
Okay, thank you so much.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to Ms. Ami Shah for closing comments. Over to you, ma'am.
Thank you. Thank you everybody for joining this call. I hope all your questions and queries are satisfactorily answered by us, and in case if there are any further questions that have been remained unanswered, you can reach out to us or Mr. Deven Dhruva from SGA and Investor Relation Partners. Thank you once again. Hope to reconnect in the next investor call.
Thank you. On behalf of Gufic BioSciences Ltd, that concludes this conference. Thank you for joining us. You may now disconnect your lines.